the double entry system. If the business buys anything, there will be accounts that are affected. The one will be debited, one will be credited. So in this learning unit, you are learning unit 4. You'll be learning how to record those transactions now in the journals. So the same principle will still be applied for which accounts are debited, which accounts are credited, but this time you are mostly recording on the specific journal. Una the cash transaction, una credit transaction. So let me just quickly open another file in the Shimsayona before we can start with this. Okay, can you see when I file in the what happened?
Yeah, mama Antonio maladero nando mutu.
Zuko wana razano. Okay, so basically hapa ka entry. So una the types of the transaction in terms of running the business. Una let me show you say highlight. Una transaction where you are buying and paying. So for each and every transaction, you just need to identify: are you buying or paying? Are you selling? Are you receiving? These are the main transactions dzine dzadzula dzikuvaoneka business. So inara dzotoma ngayo explain and you're buying. So kaya buying, it's either you are buying through on cash or either on credit. And you are paying on using cash or paying using credit. So if you are buying or paying using cash, account dzine dzagodo affect the item that you are buying as well as the bank since it's cash. So according to double entry system, you debit whatever you are buying and then you credit bank. So that item increases, or the service that we receive from that expense, it increases. So we debit the item that we are buying or paying for. So it's either a service or we are buying a resource which is an asset. So that will be debited. So because now no one have VAT, this you have to take into account. Whenever you're buying something, it attracts input VAT because you are receiving something, so it's coming in the business. So although an to input VAT, this it's an asset to the business because it allows us to be able to claim the money back from SARS. So your VAT input is always debited no matter what. Still following? So for all transaction where we will be buying, which is on cash, this means that the source document we're going to use a cash invoice received, EFT payments, or this transaction in the paid for, or EFT payment, and receipts received. This is the source document that we recorded this transaction where we are buying or either paying on cash. And then all of these transactions, the record out generally, know the fee cash book receipts, so the cash book payments. So this will be the journal in the Shumisio. So kai journal in the column that's what represent the item. Una columns in our their major column or main columns. One of the main column in the bank, yavana vet input to havana trading inventory. Chumshpinga havana stationary, then akona sundry column. So in the student we normally buy stationery and trading inventory. So when you record cash book receipts,
You cut.
you
You cut.
okay. So ka journal when you go record on the journals, you'll be using this source document. So each and every source document will tell you which journal are you supposed to record on. So for transaction where you're buying on cash, You're going to be using cash invoice received, EFT payment, or paid for transactions. Any transaction that says paid for water and electricity, paid wage, salaries and wages, as well as receipts received for water and electricity, or receipts received for rent expense. So this means that we are paying. So this will then be recorded in your cash book payment. Still following?
Mm.
That they were there.
Ndikuzvibva.
Okay, then other buying on credit. So we either sometimes we do not buy on cash, we buy on credit. This is under learning unit 5. So if you're buying on credit, it means that you're still going to debit the item that you bought or the resource that you paid for, that you are, or the service that you are receiving on credit. If you are receiving water and electricity on credit, you still debit water and electricity and creditors control, because this time around, ariko bhaderanga cash. So we're not paying anything. So your creditors control will continue to be, I will be credited to indicate a liability that we're going to pay this in the future. So because we're still receiving a service or buying an item, VAT input will still be there. So this means that namsaricho record daka the journal zaborin, VAT input idzo dzinoiko calculate you. Then the source document dzinoshumiswa mwese riko renga something on credit. It's invoice received and tax invoice received. So if it says invoice received or invoice or received invoice number, that means that we are receiving an original invoice. We are the one buying on credit, not our customer buying from us. When our customer buy from us, we issue the invoice. But the moment we receive, it means that we are buying on credit. So invoice received, tax invoice received, all of this will then be used to record transaction in your creditors journal. So in your creditors journal, a main column, the creditors control. That's your main column indicator chart. Even record zvithu zvote zvorenga on credit, including VAT amount. So over here then, which means that when it comes to buying, we have got two options. You look at the transaction, are we buying on cash or on credit? If we're buying on cash, then we're recording the cash book payments. If we're buying or paying on, if we're buying on credit, we're gonna receive an invoice or a tax invoice, then we're gonna record this in the creditors journal. Then move selling. Car selling is the same thing. We are either selling goods on cash or on credit. So if we're selling good on cash, your bank is always debited because money will be coming in the bank account, and then you will credit sales because sales is an equity account, it will increase. So the source document dzinoshumiswa, it's cash invoice and cash slip issued and cash register roll. So cash register roll, the till is sort of like a till. That's where you capture the information in which could capture or ignoring. I mean. So this means that the customer most of the time will not receive either a receipt or anything. Udoscope roll or in the source to guy. So that's a cash register roll. So we use it as a source document. So these three source document, cash invoice, cash slip, cash register roll. So they will be indicating or we are selling something on cash. So those are called workup generally known as cash book receipts. So account zinaweza affect and the bank VAT output na sales. So ambao nicho record aka cash book receipts niko record under column ya bank VAT output na sales, because there's an account which affect here when you are selling on credit. You look for these columns. Normally these are the main columns. VAT output is a liability. Every time we sell, we charge the customer VAT output because things are going out of the business now, goods are going out of the business. So hela VAT the badala raipa SARS. Here input on a reclaimer from SARS, so here output on the charge the customer. we pay it over to SARS, so it's a liability. It will always be credited. But although on a column, cash book receipts, you represent a VAT output. And then your sales every time you record it will be excluding VAT. But cap bank column, you will always record the amount including VAT and the total charge that we receive via cash, not in this on cash. Then moving forward to credit, selling on credit. When you're selling on credit, it means that you're not receiving money. So this means that we create something called a debtors control, someone who will owe the business money for goods they received on credit. So you debit debtors control, you credit VAT output, yeah, goods that are registered over to SARS. Then you credit sales. The sales will be the amount excluding VAT, your total selling price excluding VAT. Then when you sell goods on credit, the source documents that are used, it's invoice issued or duplicate invoice. We issue the invoice, which is the original to the customer, and then reissue a duplicate invoice to record in our journals. Or either a tax invoice issued, and then we use a duplicate to record in our journals. The journal that we use when we sell on credit, it's debtors journal. Card debtors journal, the main account is going to be your debtors control column. So this is going to be your main account, debtors control column. It's going to be the main account. So the cost of sales and everything will zviamba richivosvika nange panda risvika richivotita dzijenala dzona dzine kana richiwamanga dzijenala. So it means that now we have covered two concepts. Transaction where you are buying, and if it's either when you read the transaction, it says you bought this following goods or paid the following goods. So you just look for the keyword, are we buying on cash or are we buying on credit? Or did we pay for this on cash? If we paid for this on cash, that's your cash book payment. If you bought this on credit, that's your creditors journal. Source documents used for creditors journal, invoice received and tax invoice received, the original ones. But when we are selling to the customer, if we sell goods to the customer on cash, it means that this will be recorded in the cash book receipts to indicate that we received money from sales. And then columns in order that affect here, bank, VAT output, and sales. If we decide to sell goods on credit to a customer, this means that we will go and record this information on your debtors control, VAT output, and creditors control. All of this will be recorded in your debtors journal. Did you follow on that? Okay, now the account receiving. So there will be time where you will just be receiving money as an income. So when you receive money as an income, this will all be recorded in your cash book receipts. You will issue a receipt as a business to indicate to receive actually develop as a receipt. You issue the receipt. But the one that we receive, it means that that goes to cash book payments. But the moment we receive a receipt, it means that this will then be recorded in your cash book receipts. Columns in another factor here, bank, VAT output, as well as other income account. Here, income and a receive. If you go receive charity from rent income, because cash book receipts, although na column or rent income, you go to sundry column, which I will show you later on. The recorder this sundry column indicatory. Charity here I receive and here rent income. If you not receive a charity from services rendered, you will record it as services rendered. So the main key important thing, your bank account column, you will always record the total amount received, including VAT. And then you will indicate the VAT of that amount VAT column, and then followed by the uh, amount excluding VAT Cassandra account. So normally all of those where we are receiving money, they go normally to sundry accounts where you record the amount under details and then under amount, and then under details, you write the name of the account. If it's rent income, you write rent income. If it's uh, interest income, you write interest income. So this re-recorder after creating a receipt or issuing a receipt. So this is the source document used to record receipts of transaction where we are receiving money. We are not selling, but we are just receiving money from a service that we rendered. Either you rendered a service, or you rented out a business, or you're just receiving money from interest. So this will all be recorded in your cash book receipts. Then after receiving, we then have what we call goods returned by credit customer. When a customer who bought goods from us return uh, the goods or part of the goods that he bought. So this, we normally create or issue a credit note ourselves. Create a credit note and issue it to a customer. This will then be recorded in what we call debtors allowance journal. Every time customer actually visa the goods, recorder debtors control, debtors allowance journal. The account dzine the factor and the sales return indicator the goods will so value of goods returned excluding VAT. Another account will be VAT input. The reason here in a VAT input to Maraka debtors journal arena VAT output. Because Richie Rengisa charge a VAT output to customer are the goods. It means that now we're going to create VAT input or cancel the output ilena raguti badela kasas. It can no longer input. So for goods there the wisa redo calculator VAT ya one, then we call it the VAT input. Ido pungu the VAT na raguti badela to SARS because goods zungo chatua zuya mrao. And then card debtors control column in the recorder the total amount of goods returned including VAT, which either way could such a or customer who we saw with the goods. Then Havana goods returned by the business to creditors. Ndirnero renga the goods ka the creditor supplier the warine, and then the business returned goods to this supplier or to whichever business it is. So when we do that, we receive a credit note from the supplier. So the previous one, when a customer returned goods to us, we issue a credit note. When we return goods to the creditor or to the supplier, we receive a credit note. And then when we receive the credit note, this is the record creditors allowance journal. Creditors allowance journal, the recorder under creditors control the total amount of goods that you return, including VAT. And then VAT output to cancel la VAT input na rakuti iklima rera ro iklima ka SARS. We indicate ro umisa the goods. Now we are paying back SARS the VAT input that ra iklima back for those goods that we actually return to the supplier. If not return a trading inventory, we don't want to column your trading inventory. So you will record chitoko cho umiso under the column of trading inventory, and it will be excluding VAT. If you returned equipment, you will record this under sundry creditors allowance general to indicate that we returned equipment because there won't be a column for equipment creditors allowance general. And then the last journal that you're gonna deal with, it's called the general journal. So general journal, we use it to record any transaction that cannot be recorded in the other 7 journals. So una journal anything amba, it's called PT cash. So PT cash, we only record transaction where we created a PT cash voucher. So whenever a business operates, when actually the inner withdraw our bank account like keep cash, we use that to buy for smaller transactions. So those are stationary, uposta zwithu nga dzi postnet for uri postera the customer, those kind of things, the courier charges and all that, and the staff refreshment and customer refreshment, those are bought through PT cash. So that PT cash journal, we cannot have a transaction that is more than 2,000 as a once off. So PT cash journal is used for transactions that are less than 1,000, where we are buying or paying for something that is less than 2,000. So we use a petty cash journal. Normally for those journals, for the transaction is a petty cash, it will say paid for using petty cash, or a petty cash voucher was created. So source documents a petty cash, it's petty cash journal. If you are asked about uh, to explain how petty cash works, so petty cash, we use it for transactions that are less than 2,000. And those transactions include staff refreshment, customer refreshment, and business stationery, minor business stationery that are used on a daily basis. So that's what we use petty cash for. And all transactions recorded in the petty cash, we use a journal voucher. So coming back to this one, the main one, the general journal. So in terms of general journal, any transaction that cannot be recorded in the other servant's journal will then be recorded in the general journal. And when we record those transactions, we raise what we call a journal voucher. A journal voucher is what we're going to raise to be able to record on the general journal. So the transaction is not as a record. Settlement discount. If ro ringisela custom something, ava ku ri badela tshelede yawe ri na yoṱhe, ra mufha discount. The discount ine ra mufha a tshi khou badela tshikolodo, we're gonna record it kha general journal. The percentage. If customer khou ni koloda 10,000 and you give them 2,000 settlement, 2% settlement discount, zwi amba uri hu khou ḓo vha na 200 rand ya discount kha that 10,000. So this means that that 200 will be recorded in the general journal. In the debitor, discount received, and then the creditor, debtors control. I will also show you the transaction as a general journal. And then also when we are correcting any errors, meaning that araro recorder something which we cannot be able to rectify through these other books. There are issues what we call general journal to correct an error in our ledger accounts. Also, when the owner takes stock for personal use, ni nga si kone u tshi recorda kha cash book receipts, cash book payments, debtors journal or creditors, because it does not fall within any of those. So every time the owner takes stock for personal use, ni ḓo tshi recorda kha mini, kha general journal. But when the owner takes cash for personal use, because it is cash, it's going to go to cash book payments to indicate that the owner withdrew cash. So that's going to go to cash book payments. But when he takes stock, we are not selling the stock, he is taking it. So this means that it will be recorded ka general journal. And then assets contribution by owner. If the owner contributed an assets, you will also record this in the general journal. You will debit the account of the assets being contributed and credit capital account. But when the owner invest or deposit cash in the business as capital, that cash will be recorded in cash book receipts. But when they invest assets, because we cannot record a receipt of assets because it's not cash under cash book receipts, it will be recorded in general journal. When you charge your customers interest, your debtors interest, you will record it in general journal. When you are charged by the creditor, when you charge interest, you will record those interest in your general journal. So this is the whole concept of learning unit 4 and 5 and 6. So learning unit 6, I will explain. Learning unit 6, it only differs because it's talking about periodic inventory system. It's emphasizing on periodic inventory system. Learning unit 4 and 5, they are focusing on perpetual inventory system. Every time you sell something, you update your cost of sales account as well as your trading inventory. But under periodic inventory system, there won't be any cost of sales account. So this means that Nicho recorder, the transaction is a look at the journal, although was in a column cost of sales, and although was in a column trading inventory, although in a column with if you purchase this, every time you buy stock, it will be recorded under purchases. And the charges, the transportation charges, the custom duties charges, they will be recorded as expenses, separate expenses, as they include the incoming purchases account. But under perpetual inventory system, because we update trading inventory and our cost of sales, it means that any transaction in a record here are chitoko re do update our inventory account ara ro charge your transportation cost to import duties re do the include kha ila account ya trading inventory to increase the value ya chitoko because they are part of the stock cost. So that is the difference between perpetual and periodic inventory system. So did you follow everything?
Mm.
Okay, so do meranga ka canton ka femini ka slides. So the jump as soon as the slide because I've already given you much into information. So these are all the journals we have. So you have got a cash book receipts, cash book payments, petty cash for small amount transactions, and then you have got debtors journal, you have got creditors journal, debtors allowance, and general journal. In total, there are 8. Cash book receipts for all cash receipts transaction and cash sales transaction. Cash book payments for all cash payments transaction where we are paying someone, including our supplier. Petty cash journal for all purchases of small items. So this one, we create what we call a petty cash voucher in order for us to record in the petty cash journal. Debtors journal, when we are selling goods on credit, every time you sell goods on credit to your customer, it will be recorded in the debtors journal. Every time you buy goods on credit from a supplier, you record it in your creditors journal. Whenever a customer returns goods that they bought, you record them in your debtors allowance journal. Whenever we return the goods that we bought from our supplier, we will use the creditors allowance journal. So this is the first key thing that you need to make sure that you understand. So an abbreviation, and then there will be types of transaction. At show if this is it's there because the slide is underneath previously. So to make sure that you master everything that is here, make sure you practice this question for the exam. It will also help you to test or understand that the whole concept of journals and just the basic theory in terms of how journals works. Question 4.1. So it's gonna be asking you if customer ordering on credit, which source document is used. So normally that's going to be uh, invoice issued or tax invoice issued. And then this will be recorded in debtors journal. So that's what this whole question is all about, is trying to see if you know which source document is used to record on which journal. So the same thing previously under Learning Unit 2, you just learned about transaction. But under Learning Unit 4, 5, and 6, we talk a lot about source documents, which was explained in Learning Unit 3. So every time a transaction occurs, there is a source document that is used to record the transaction as evidence so that which is that the audits, NAMS and submit information casals or tax, they're gonna use those to invalidate to reveal that this transaction actually exists, it was recorded. Without those source documents, then it will be considered uh, any transaction you record will be considered money laundering or tax avoidance, which is going to you are going to be penalized. Still following? Charlotte?
Eh.
Okay, so this is a cash book receipt. So this cash book receipts, it will indicate on top there will be a heading, though a heading. So it will indicate cash book receipts of. You write the name of the company. For the month of, you write the month. And then where it says CBR, you write the number of the month. If it's Reka June, you write 6. If Reka July, you write 7. If Reka December, you write 12. To indicate this book or this journal or this cash book receipts, yovulwa nga mwedzi wa March ndi ya March. So that's what it will mean. So each and every month, we open a new cash book receipt and record transaction in that for that particular month. Arivuli cash book, arivuli journal mwawote. Every month, a new journal is opened. And then at the end of the month, we total all the journals and post them to the ledger accounts. The ledger accounts are the ones that are used to summarize all the transactions that occurred through the month, and the balance are carried forward until the year end. So at year end, the nominal account section, which are the income and expenses account, we then close them off, but that you're not going to cover. So what's mostly important is to understand that every month there will be a cash book receipt open for that particular month, and it will be given a name. If you go for a cash book receipt, it will be cash book receipts 5. If you go for a cash book payments in June, it will be written cash book payments uh, 6. And then it will only record transaction is a June phase. June chifera, we close the book, we take the total as the column, as the poster according to those accounts. For example, we have got bank here. So I'm about totally a bank column about the poster ka bank ledger account. Totally output vet here about the poster ka output vet account, ka ledger account. Richi thoma ṅwedzi u tevhelaho ri ḓo calculator total balance ine ra ḓo thoma nayo kha ledger. Then ṅwedzi wa July ri ḓo vula cash book receipts ntswa ra recorder transaction dzoṱhe dza July kha cash book receipts ya July. Ri tshi fhedza total i ḓo ya postwa kha dzi account, those similar account. So this is the cycle of um, accounting until year end. Resulted this until year end, and then year end we're going to prepare the financial statements that were in. So from these cash book receipts, there are following things. Una doc column, which you're gonna record the document number. If transaction issue is a raw issue or a receipt, you write RT na number ya receipt. If we sold goods on credit and we issue a cash receipt, you will write the cash receipt number. If transaction you record work cash register roll, you will just write CRR, indicatory transaction here you record work cash register roll. The day you write, it will be the day of the month. So since a cash book receipt is the way June, apa ka day, we just only write the day. We don't have to write the month because CBR 6, CBR